You know, the industrial sector in 2025 has been, well, a total roller coaster. And right in the middle of it all, you've got this fascinating showdown between two giants playing completely different games. You've got the established champion, Illinois Toolworks, or ITW, and then you have this aggressive up-and-comer, ESAB. So today, we're going to tear down their 2025 numbers and figure out who actually won.
So this really gets to the heart of it, right? What's the winning play in a market like this? Do you bet on the company with rock-solid discipline, the one that focuses inward, or do you go with the disruptor, the one that's out there making waves and growing like crazy on the outside? It's a classic battle, and believe me, the numbers paint a really interesting picture.
All right, let's get into it. Time for the tale of the tape for 2025. We're going to put these two industrial heavyweights right up against each other.
Okay, first things first, let's get a feel for who these guys are. On one side, you've got ITW. I mean, they're the definition of a blue-chip industrial giant. Think of a massive, stable, diversified conglomerate. On the other side, there's ESAB. They're way more specialized, and they call themselves an industrial compounder. Now, that's just a fancy way of saying their main growth strategy is to go out and buy up other companies.
Whoa, okay, so right away, look at the scale difference here. ITW is a behemoth, right? Their revenue is almost 6 times bigger than ESAB's. But, and this is the big but, look at that growth rate. ESAB is growing nearly 4 times faster. This one slide tells you everything you need to know about the story we're unpacking today, the slow, steady giant versus the small, nimble challenger.
So you've got to ask, how are they pulling this off? I mean, those numbers don't just happen by magic. Each of these companies has a completely different playbook for growth.
And here they are. ITW's whole world revolves around their 80-20 model. It's genius, really. They figure out which 20% of their customers are bringing in 80% of the money, and they focus all their energy there. Everything else, they cut it. It's all about internal efficiency. ESAB? Totally different story. They're all about M&A, mergers and acquisitions. They grow by buying their way into new markets.
Okay, now this table puts it all into perspective. It's so clear. Look at ITW. Organic growth is totally flat. And you know what? That's kind of part of their plan, since they're always cutting the less profitable stuff. But then you look at ESAB. Holy cow. Their entire growth story in 2025 came from buying other companies. That 4.2% from acquisitions is actually hiding the fact that their core organic business shrank a little bit. That's a huge tell.
All right, let's switch gears a bit and look at the global map, because where these guys make their money tells you a ton about their appetite for risk. ITW is basically a fortress with its foundations dug deep in the US. I mean, look at that. Almost half of their entire revenue comes from the United States. It's a stable, predictable home base, which is exactly what you'd expect from a company like them. And then there's ESAB. It's the complete opposite. It's almost unbelievable. A whopping 80% of their business is international. They're making a massive all-in bet on the rest of the world, not on their own backyard. And make no mistake, this is a calculated gamble on both sides. ESAB is diving headfirst into high-growth emerging markets. We're talking places like India, South America. More than half their revenue is from markets that are expected to grow at double the speed of places like the US or Europe. ITW, on the other hand, is much more selective. They stick to their stable base but will jump on very specific hot opportunities, like they did with the EV and semiconductor boom in China. Okay, so we've talked about growth, but is it good growth? Is it profitable? This is where it gets really interesting, folks. We're about to pop the hood and look at the profit engines of these companies. So even in welding, a business where they go head-to-head, their approaches are night and day. ITW treats its welding unit like a profit pearl. It's this super efficient, high-margin gem inside their big company. ESAB, though, they're all about the razor and blade model. You've heard of this, right? They sell you the main piece of equipment, the razor, at a reasonable price because they know you'll be coming back again and again to buy the high-margin consumables, the blades. And for them, that's 2/3 of their sales. It's a brilliant way to lock in customers. And what does that discipline get you? Look at this number. ITW's welding business has an operating margin of almost 33%. Let me just say that again, 33%. For an industrial company, that's not just good, it's absolutely elite. It's world-class. It's frankly kind of insane. Now, ESAB is no slouch. Almost 20% margin is really good. It's a healthy, solid number. But when you see it next to ITW's number, you really get it.
You see the power of that 80-20 model. It's the difference between having a really good business and having a finely tuned profit-printing machine. But this is where we have to ask a tough question. Is ESAP's growth story maybe a little too good to be true? Because when you really start digging into the details of their 2025 reports, a couple of things stand out that, well, they definitely make you go,
So let's look at these potential red flags. First, their inventory shot up by over 19%. That's huge. But their revenue only grew by 3.7%. See the problem? They've got stuff piling up on the shelves way faster than they're selling it. Then there's this. The amount of money they put aside for customers who might not pay their bills, it actually went down. That's happening while their sales are going up, and there's more risk in the world. You put those two things together, and it could be a sign of some aggressive accounting, or maybe some write-downs coming down the line.
okay, so we've laid it all out. We've looked at the growth, the profits, the risks. So what's the final verdict? Well, here's the thing. There isn't one answer for everyone. The winner here really depends on you and what you're looking for as an investor. Let's say you're a defensive investor. You want stability. You want to sleep at night. You want a company that's built like a tank. If that's you, well, ITW is looking pretty good.
I mean, ITW is the definition of a defensive stock. A 26% operating margin across the whole company? That's just incredible. They consistently give cash back to shareholders, billions in dividends and buybacks in 2025 alone. And their financial health, the safety net is huge. Plus, because they're spread across 7 different business lines, if one sector has a bad year, it doesn't pull the whole company down. It's built to last.
But what if that's not you? What if you're looking for growth? You're willing to take on a bit more risk for the chance at a much bigger reward? Well, then you've got to take a look at ESAB.
With ESAB, you're making a high-stakes bet. You're betting on those fast-growing emerging markets, and you're betting that their big M&A strategy, like that massive acquisition of Edify, is going to pay off. The potential upside is way higher, a chance to really grow your investment. But the risks are real, too. You've got lower margins, more debt on the books, and yeah, those accounting red flags we talked about. It is the textbook definition of a high-risk, high-reward investment. So we've come full circle. This really isn't just about picking ESAB or ITW. It's about picking a strategy, a philosophy for value creation. So the question for you to think about is this. Over the next decade, who's going to win? The disciplined master of execution that perfects every little detail? Or the bold, disruptive acquirer that's constantly changing the game? That, right there, is the question. Look, we've covered a lot today, but this is really just scratching the surface. If you want to dive deep into all the numbers, see our full financial models, and read our complete breakdown, head on over to our website and download the full report. And hey, let us know what you think. Discipline or disruption? I'd love to hear which side you're on.